What if the financial advice you are being given by mainstream media, retail banks, and Wall Street stockbrokers is deliberately designed to keep you trapped in a collapsing system while the ultra wealthy quietly secure the exit doors? Every single day, the public is flooded with a universal narrative. Television anchors, corporate financial advisors, and institutional market commentators repeat the exact same mantra. The economy is resilient. Market volatility is temporary. Keep 100% of your savings invested in traditional index funds, sit back, and do nothing. To the average middle class worker trying to build a retirement portfolio, this sounds like safe, disciplined financial wisdom. But behind the closed doors of elite family offices, sovereign wealth funds, and multi-billion-dollar hedge funds, the actual controllers of global capital are executing a completely different playbook. While the retail public is being urged to buy the top of a top-heavy market, the institutional elite are quietly de-risking their portfolios, liquidating paper liabilities, and aggressively accumulating physical, non-correlated assets. They are not playing by your rules, and they are certainly not relying on your safety nets. According to billionaire macro investor Ray Dalio, the legendary founder of Bridgewater Associates, this stark divergence in behavior isn't an accident. It is a mandatory historical structural feature of the late stages of a long-term debt cycle. When the financial architecture reaches its ultimate leverage constraints, the elite do not try to save the system, they structurally insulate themselves from it. In this video, we are going to use the Dalio Blueprint to conduct a brutal forensic investigation into institutional capital flows. We will decode the exact, confidential movements of the world's largest hedge funds, reveal the mathematical hypocrisy of conventional investment advice, and step by step, outline the precise structural framework you must deploy today to allocate your capital exactly like the 1% before the machine inevitably resets. Let's look inside the curtain. To understand why the elite act in complete secrecy during a paradigm shift, we must first look at the fundamental conflict of interest built into the retail financial system. Ray Dalio has spent 50 years managing institutional billions for central banks and tech billionaires. He understands a reality that everyday investors completely overlook. Wall Street is a volume-driven sales machine, not a wealth protection sanctuary. Think about the mechanical business model of a major retail bank or a massive asset management firm. They do not make their billions by guaranteeing that your purchasing power survives inflation. They make their billions on management fees. To sustain those fees, they need trillions of dollars of consumer capital permanently locked inside their mutual funds, retirement accounts, and equity products. If a major bank stood on a stage and honestly warned the public that a massive debt contraction or a structural paradigm shift was closing in, millions of regular savers would immediately pull their cash out of the market and move into safe haven assets. This would trigger an immediate collapse in institutional stock valuations and wipe out corporate fee revenues overnight. Therefore, the system's primary objective is to maintain a state of permanent, artificial optimism. They need you to remain passive, holding the bag at the absolute top of a debt-fueled asset bubble, while they systematically execute their own exit protocols. Ray Dalio's extensive research into 500 years of market history reveals that this exact institutional game has been played at the end of every major empire's debt cycle. Whether you look at the final stages of the Dutch guilder in the late 18th century, the British pound sterling crisis in the early 20th century, or the modern financial landscape, the elite always follow a highly coordinated, three-step capital reallocation protocol that remains completely hidden from the general population. Step number one of the elite playbook is the aggressive liquidation of credit counterparty risk. The average investor believes that keeping money in a large commercial bank or holding high-quality corporate bonds is a safe strategy. But Dalio warns that in the late stages of a long-term debt cycle, credit becomes an unstable illusion. A bond is nothing more than a promise to be paid back in paper currency at a future date by an institution or a government. If that currency is being printed to infinity to monetize unpayable national debts, the real purchasing power of that future payment drops to zero. The elite understand that when a system is drowning in debt, any asset that relies on someone else's promise to pay carries immense hidden risk. That is why the world's most sophisticated family offices have spent the last 24 months quietly reducing their exposure to long-term fixed income paper. They are fleeing credit counterparty assets and shifting that capital into short-term, highly liquid sovereign treasury bills or cash equivalents that protect their nominal baseline from immediate default while they wait for asset prices to correct. Step number 2 of the corporate playbook is the strategic transition from paper financial assets to tangible wealth modules. While retail savers are told to buy digital shares of overvalued technology companies, the institutional elite are aggressively buying up finite, physical assets that cannot be manufactured by a central bank printing press or erased by a corporate bankruptcy. Look at the quantitative data regarding global capital flows. Ultra-high net worth investors are quietly accumulating industrial logistics hubs, vital energy infrastructure, high-yield agricultural land, and data center real estate. These aren't speculative hype assets. They are essential pillars of physical human survival that possess true pricing power. If a massive inflationary wave hits the economy, a multinational logistics hub can immediately raise its leasing fees to match inflation, protecting its real capital value. The elite are locking down the physical entry points of global production, ensuring that no matter what happens to the paper stock market, they retain fractional ownership of the real world. Step number 3 of the playbook is the unprecedented accumulation of the ultimate systemic insurance policy, physical gold. For decades, traditional financial advisors have ridiculed gold as an outdated, non-productive asset that belongs in the past. They tell retail investors that a stock index fund is a superior vehicle for growth. But while the public ignores gold, the world's ultimate institutional insiders, international central banks, are buying physical gold bars at the highest velocity recorded since 1967. Why are the very institutions that control the printing presses accumulating gold in absolute secrecy? Because Ray Dalio's historical research proves that gold is the only global asset that carries zero counterparty debt risk and cannot be devalued by a sovereign state decree. When a reserve currency empire reaches its structural leverage limits, gold automatically acts as the ultimate denominator of value. The elite are not buying gold to speculate or make a quick profit. They are buying it because they know it is the mandatory foundational anchor that will survive a systemic currency reset. They are building a golden lifeboat while telling the public to stay inside the paper ship. To apply the Bridgewater playbook to your personal portfolio today, you must completely eliminate your emotional dependence on conventional financial advice. You must stop acting like a passive consumer of Wall Street products and start acting like a sovereign asset allocator. The Dalio Blueprint requires restructuring your capital stack into independent, non-correlated modules that match the exact protective footprint of the ultra-wealthy. First, allocate 30% of your capital to a globally diversified equity module. Do not make the amateur mistake of concentrating all your wealth inside a single country's tech index. Use low-cost global trackers like VTI and VXUS to distribute your growth engine across multiple foreign currencies and multinational corporations that operate across independent political jurisdictions. This ensures that if a severe domestic tax wave or a regional credit crisis hits your home country, your underlying equity capital is legally distributed across global production nodes that are insulated from local intervention. Second, allocate 55% of your retirement baseline to a fixed income capital preservation module using Ray Dalio's strict risk parity rules. This core is systematically split between 40% in long-term treasury bonds via TLT and 15% in intermediate notes via IEF. This massive defensive shield is your absolute protection against an overnight corporate liquidation event or a systemic credit contraction. It is the unhype anchor that preserves your nominal buying power when the speculative tech bubble pops, giving you the liquid cash required to acquire world-changing assets at a deep discount at the bottom of the cycle. Third, deploy the final 15% into the hard asset inflation shield. This is split evenly between 7.5% in physical gold via GLD and 7.5% in diversified global commodities via DBC. This 15% block has a zero or negative correlation to your stock and bond modules. When public faith in paper markets fractures and inflation spikes, this hard asset block will experience massive vertical moves, acting as a direct mathematical offset to protect your total net worth from being inflated away by central bank debt monetization. But the final, most critical component of the corporate playbook is the mechanical enforcement of periodic rebalancing. This is the exact inflection point where the retail crowd loses and the 1% wins. When a specific asset class is experiencing a massive, historic bull run, human psychology forces the average investor to buy more of it at the absolute top out of pure greed. But the elite completely remove human psychology from the equation. Once a quarter or once a year, they look at their structural target percentages. If a tech boom has pushed their equity module from 30% up to 45% of their total wealth, they systematically sell that extra 15% at the absolute peak of the market and immediately reallocate that cash to buy the underperformed, discounted bonds and hard assets. They are mathematically forced to sell high and buy low, completely ignoring the media narrative. The global economic machine is running on an unsustainable foundation of unpayable debt, synthetic liquidity, and artificial optimism. The traditional advice handed down to the middle class is a dangerous playbook engineered to keep your capital captive while the institutional elite secure their exits. The choice before you is no longer about trying to force an outdated system to work for you. It is about decoding the real actions of the 1%, protecting your capital from melting cash traps, and transitioning your strategy from consumer desperation to structural asset parity. Optimize your allocation, automate your discipline, and protect your freedom.